Well, good morning, Frankfurt. Dear guests from numerous countries and regions, welcome to our 53rd Food for Thought event in cooperation with the Association of Foreign Banks in Germany. A big thanks to our partner. Today, Frankfurt is again 1 hour ahead of London, so let's make the best of it. Our focus today is the Financial Information Data Access Framework, or FIDA. A new regulation that redefines the scope and scale of open finance across the European financial sector. When I started my career in banking, digital account management was not yet invented. There was just a lot of paperwork. But even back then, bank customers dreamed of being able to find their financial information in one place, clearly organized and across all institutions. For those dreamers, the Payment Service Directive 2 already was a big step forward. As you may know, the FIDA will soon go beyond what we saw with PSD2. FIDA's reach is broader, covering more products and more data points. It is introducing new mandates such as the obligation for financial institutions to join FIDA schemes. This shift not only marks a new era in data accessibility, but also presents both challenges and strategic opportunities for banks and financial institutions. We are gathered here today with Mr. Sebastian Maus, partner of Oliver Wyman's payments practice. He will address the topic of FIDA, the next step towards open finance in Europe. He will share insights on what this new framework entails, how it impacts the European financial market, and crucially, the choices institutions must take in positioning themselves within the FIDA schemes. He will also discuss the chance for the private sector to help shape these schemes, effectively setting the rules of engagement for the future of open finance. Mr. Sebastian Maus has been supporting clients from the global payment industry for over 20 years. He advises retail and corporate banks, payment service providers, acquirers, merchants, corporates, card organizations, and payment schemes in Europe and selected international markets. His consulting focus ranges from strategy development, growth initiatives, and the establishment of new business models to digitization and transformation programs. Dear audience, please feel free to input your questions during or after the speech in the Q&A section in Zoom. We look forward to receiving your questions. Sebastian, welcome. The stage is yours.
Perfect. Thank you so much, and good morning to everyone. Very much looking forward to talk today a little bit with you about FIDA, the new regulation which is coming in the European market. You share my screen. Can you see my screen all? I hope so. Good. So what I would like to talk with you today about is a little bit 3 quick questions at the end. The first one, what is FIDA and why is it important for financial institutions? Then I would like to explore a little bit what will be the impact of FIDA on financial institutions and what are actually their strategic options. And third one, what financial institutions should do to react on FIDA. As already mentioned in the introduction, FIDA is a new piece of regulation which fits in a broader, I would say, regulatory strategy in the European market. We have seen in the last years the way towards open banking with the introduction of PSD2 and now also PSD3 and PSR, which was like requesting the banks to open up, in particular, their payments data and access to their payment systems. And now FIDA is actually the much broader regulation, which addresses different product categories, different data sets, and is therefore far beyond the traditional scope of PSD2 and PSD3. And FIDA also is embedded in a more like horizontal regulation, which is taking place around Europe, which is, first of all, has the objective to give the customer back control about his data. And secondly, in opening up the data silos and opening up the economy and the financial sector towards free data sharing. So we have regulations like the GDPR, the DMA, the Data Act, or also EIDAS, which are also going in the same direction and supporting the overall strategy of open markets. When we look at FIDA in particular and the scope of FIDA, we can say that FIDA is actually covering almost everything which is currently within the financial sector. So all the product categories, for example, the lending products, saving products, investment products, insurance product, or pension products, but also other data which is held, for example, for KYC processes or creditworthiness assessment. FIDA also covers everything or all client segments. So the retail segment, the SME segment, and even the corporate and investment banking institutional client segment. There's still some discussions about the final scope of FIDA, but in general, all the three client segments will be in scope. And another big difference of FIDA is that FIDA is also within those product categories, addressing all different type of data which are available. So for example, in the lending space, third parties can get access to information like the balances, the conditions, the interest rate paid, also the guarantees which are given. And therefore, there are completely different new use cases possible. And I think one of the questions we are quite often asked when we discuss with banks and financial institutions about FIDA is actually what is the difference to PSD2 and why should this time FIDA be really have an impact on the market? Because a lot of people were saying at PSD2, everyone was having the same thoughts that the banks will be disrupted, that there will be a lot of use cases and a lot of leverage of the new regulation. But if you look back, I mean, there have been obviously some players definitely benefiting from open banking, the PSD2, but the adoption is not as broadly as probably many of us were expecting it to be. And what is now different with FIDA? I think we think there are 5 different arguments for it. First of all, as I already mentioned, the much broader scope of data. While at PSD2, we were discussing in the market via the account data, you can, for example, get some insights around the insurances a client has and can estimate the size of his household, for example. In the case of FIDA, you can really get these information now. So the financial institute needs to share those data with you. So therefore, there's much richer data available for use cases. The second topic is the market changed. Since PSD2, many years have passed, and we have actually seen that, first of all, the banks are much further advanced on the whole digitization. So also what to do, for example, with this data they can collect, and also third party, what they can do with this data. Secondly, we see that customers have been much more used now to actually sharing data and financial data to get some value and some additional use cases. And thirdly, we have also seen in particular in the last, I would say 12 to 24 months, a lot of drive within financial institutions around AI and generative AI and really new technologies which help you to leverage also this big amount of data and really take some significant conclusions out of it. The third element which has changed towards PSD2 is that now with FIDA, there is the need actually for FIDA schemes. FIDA schemes will be rules and regulations and how data is exchanged between different data holders and data users, will define the processes, the technology, the governance, for example, and those data schemes will actually be built by the private sector. So compared to many other schemes which have been defined on a European level and have been defined by the regulator, this time the regulator said we give it in the hand of the private sector to define the scheme between each other, and then also set the rules which work for them both and which also allow them to build, for example, business models on top of the open finance world. The fourth argument is the monetization. PSD2 was for free, so banks could not take any fees for exchanging those data. This was obviously quite often also a point for complaints of banks. But with FIDA, as I mentioned in the schemes, you can now also regulate and agree upon a compensation mechanism for exchanging those data. And the last argument, there were also fines at PSD2 and not being compliant to PSD2. But we see now actually within the FIDA regulation, there are severe fines which are achieving much higher maximum fine levels as, for example, under PSD2. So therefore, we see that the regulator learned a little bit out of the PSD2 experience and applied many of those lessons also now in the FIDA regulation. One important thing I was just mentioning is the schemes, FIDA schemes, and also big difference towards PSD2. And the schemes, as I mentioned, is regulating between the data holder and the data user, the exchange of data. And the scheme should therefore comply like different elements like the governance and membership, the technical standards, the compensation model, liability, also change procedures, also dispute mechanisms. And those schemes, as I mentioned also, will be built by the private sector, should be built by the private sector. Now we have seen in the scope of FIDA that FIDA is very diverse from the product categories in scope. So meaning lending, saving, investments, P&C insurance are completely different or often completely different players involved. So therefore, there is our hypothesis that probably there won't be one scheme across these different product categories, but there might be several schemes across those product categories. On another dimension, when we look at the EU countries, we have set 27 countries in scope. The question is also here, will we be able to have one European scheme, for example, for lending? Or is it more probable that we will actually have one scheme per country, per product category? And this could obviously result in a very fragmented landscape. So if we would assume maybe a little bit the worst case, that we have 5 schemes per country and 27 European countries, we would talk about 135 schemes in the European market, which would mean significant complexity for implementing. Also, a lot of like differences in the compensation models, for example, for then also for large European banks, for also doing the invoicing and the billing at the end of those data services used. And therefore is probably a scenario which banks and financial institutions in general should try to prevent. And therefore, we see at the moment a lot of financial institutions and in particular also associations engaging on a European level to proceed on the topic of scheme building. We have already some schemes which are also in discussion to be used for FIDA, for example. We have the European Payment Council, we have in the German market the Geo API, we have the Berlin Group as a standard in PSD2. So there are a lot of like maybe starting points for building those FIDA schemes. We also see some new initiatives which are ongoing, for example, in the insurance industry with BPRO, also in the Dutch market, a lot of initiatives ongoing. And the big question will be how actually, what is the right setup for those schemes? Will they be national? Will they be pan-European? Will they be focused on single product categories, or will we be able to really do them in multi-product categories? And this is something where there's also a little bit of a time pressure on, because the EU regulator defined that the private sector has 18 months to develop those FIDA schemes. And in case they're not able to develop those FIDA schemes and define their own rules of the game, the EU regulator might intervene and define a European-wide FIDA scheme, which is obviously something the banks and the financial institutions want to prevent. When we look at the FIDA timeline, some people say that FIDA is still very much down the road. This might be, but if we talk later a little bit about the implications, we also see that there is a lot of work to be done to be FIDA compliant and FIDA ready. And we actually expect now in November the council adoption of the FIDA. And then at the end of or the third quarter of 25, that FIDA really enter into force. And then the time starts ticking for the scheme development, but also for preparing the implementation and the FIDA compliance on the side of the financial institutions. So first going live is expected to be fourth quarter of 27. So we're talking about 3 years for the first product categories to go live with FIDA. As I mentioned, there is still some discussion also around the scope of the FIDA regulation. And we see in particular 5 points which are leveraged by the financial service industry and try to bring actually into the council's decision. One topic is around the confidentiality, to exclude clearly some confidential business data and trade secrets in the data which needs to be shared. The second one is the scope of FIDA, which is, as I mentioned, currently involving retail SME clients, but also institutional clients and professionals. And in particular, the professional institutional clients is a request by the financial institutions to exclude them from the regulation. The third topic many financial institutions are driving to influence is also the scheme enforcement. So to really make sure that FIDA data sharing is only allowed when participating in a scheme, and therefore also enforce the participation and also the data security of the data exchange. The fourth one is around the market demand. So incorporate also the market demand into the data sharing and scheme development. And the last one is the timelines, to loosen the timelines a little bit and introduce adequate scheme implementation guidelines or timelines, because 3 years is seen by many institutions who are like actually looking into the FIDA regulation, like that, yeah, many time, you know, a lot of not so much time. Sorry. So that's a little bit on what is FIDA and why is it so important for financial institutions. In the following, I would like to talk a little bit about the financial or the impact on FIDA on financial institutions, and also what we see how banks and financial institutions in general can react on FIDA. As a first statement here is that we believe that FIDA can present a significant disruption of the market. There are some disruptive factors, like for example, new customer proposition, which will be available through FIDA, with, as I mentioned, the broad access of available data, and therefore reinforce actually the discussions on a little bit fragmentation of the industry and like also fragmentation of the value chain of banking today, so that we will have the opportunity for other players to position at the client interface and offer financial products via this access to open finance. And this can also lead to significant shift in roles within the ecosystem, so that currently players which are more product providers can actually replace their distributors today, because they now have direct access to the end clients and therefore can skip the distributors. We also see a disruptive factor in embedded solutions. So in particular on the customer front end, when we talk about technology providers, being it like big tech companies, ERP systems, which are very close at the SME or corporate interface, also like some digital ecosystems, which are very close to the consumer, which now can much deeper integrate financial services products within their offerings. And the fourth disruptive factor is with AI, as I mentioned already at the beginning, there are completely new opportunities in how you can also work and leverage this data you can access and can make automated recommendation also towards your client. For financial institutions, we see actually 4 main opportunities coming out of FIDA. The first one is the availability to offer now hyper-personalized products through a true 360-degree view of your client. So you're not just knowing now the current bank account or saldo on the bank account of the client. You also know his situation on the savings side, on the investment side, on his pension schemes, etc. And you have completely different opportunities to offer him a long-term financial planning, for example. We also see as a second benefit opportunity that you can improve your existing products through the new insights and also through to new transparency about the product of your competitors. Imagine you can get all the data of your clients, what he's paying for other loans or which interest rates he's getting on his saving products, on investment products, with pressing one button, and therefore can price compete with the competitors, with the other suppliers of your client. We also see some opportunities on the efficiency side. So you can leverage, for example, KYC data and onboarding data, and therefore simplify and reduce your own onboarding process, which has obviously also significant efficiency opportunities for you. And last but not least, there's also an opportunity to monetize directly via data sharing. The value per transaction per se or per data point shared is probably quite small at the end, but as always in a transactional market, the amount of transactions is at the end giving you the total revenues. And the same as, for example, in the payments industry, this can sum up to significant values as well. As I mentioned a little bit, the opportunities on the product side, here some ideas and a first overview about what FIDA data can enable on new use cases and business model. Obviously, always with the customer permission, same as PSD2. So the customer needs to give his permission to share the data and to give third parties access to it. There are totally more than 80 use cases nowadays which have been identified around the different product categories for customers. Here just some examples. For example, the faster loan refinancing with third-party access to your conditions and therefore the ability to offer transparently in the market to get the cheapest availability without you filling out something like today at price comparison websites, for example. But again, just with pressing one button. The long-term financial planning, really having a holistic view about your financial situation and also your long-term financial situation, and therefore being able, for example, to do wealth management for the mass retail market. Also, again, pressing one button. KYC optimization I mentioned for the corporate clients in particular, as it helps you to streamline your data collection. And also like credit worthiness assessments to have better and automated credit decision due to the improved data points you can collect about the clients. And these are just some examples we see in the market. However, the introduction of FIDA also poses some relevant threats for financial institutions. The first one is in particular that new players can capture the customer interface and pushing between the bank and the clients in offering financial service offerings. And the bank at the end gets a role more of a product factory or product commodity. Therefore, also that we see significant revenues at risk from the increased competition and more transparency about prices. Another threat or risk is also that there come significant costs from implementing FIDA, and significant part of this cost, estimated currently around 80 to 90%, is actually for compliance only. It's not even to leverage the opportunities we described on the slide before, but it's really like just to being compliant, because there's a lot of things banks and financial institutions need to do. And then the potential complex and fragmented operating model resulting out of the high fragmentation of the scheme landscape in Europe, which forces banks to maybe join several schemes with different technical standards. and also an increased fraud and AML risk via opening up the systems of the banks and sharing those data. Just to give you also one more data point, from our experience and from some work we have done, we actually estimate in certain product categories and certain client segments that the revenues at risk for financial institutions can be up to 40% of their current revenues, due to the fact that now this revenue or this data and the client relationship needs to be shared with third parties. This can mean, if the banks are not reacting accordingly, this can mean a significant, obviously, impact on the business. But also, besides the business and revenue impact, FIDA is also requiring a lot of adjustment on the product side and on the IT side, resulting in our perspective in larger transformation programs required for the banks. For example, the banks need to open up their IT systems and need to open up all the systems which hold customer data today via APIs. They need to provide continuously real-time data access to the client. So that's also one of the elements of FIDA, that it's real-time data and real-time access. FIDA also requires that the consumer or the customer gets a dashboard where he can manage his access and also withdraw the access rights for certain data points. And the business implications I already mentioned before. So when we look at a typical financial institution, the FIDA transformation program will probably impact around like 80% of the products the banks are offering or the financial institution are offering, and 70% of the IT systems. And considering this, and obviously it always depends a little bit on how far the bank is in the opening up of their system and the implementation of APIs. But from the studies we have done, we see that the CapEx investments, or the one-off investment which is expected for the FIDA implementation, is around 2 to 3 times the PSD2 investments. So therefore, this means significant volumes and obviously also significant amount of IT resources needed in the next years to really prepare for the FIDA world. When we look now on how banks can actually react and what are the opportunities for banks, there are different dimensions to look at. The first dimension is the compliance readiness. And obviously, we all agree that every bank and every financial institution needs to be compliance ready. But there are different ways how you can do it, right? You can be very, I would say, supportive in addressing this compliance, and therefore have a maximum degree of fulfillment of the compliance regulation. Or you can also make it maybe a little bit more complicated for external parties to join and to access your API world. Another dimension is the breadth of use cases and also usage you want to leverage. Do you want to focus more on operational efficiency? Do you want to improve your current offering or your customer experience? Or do you really want to also build new business models? As I mentioned before, for example, the 360-degree financial planning, which are completely new products, which as a bank you typically not offering today. These are different dimensions you have on your decision. And the last one, also which role you want to play in the ecosystems, in the scheme ecosystems in particular. So do you want to be an active driver as a financial institution to develop this scheme, FIDA schemes? Or do you want to be just a contributor and at the end join a scheme which is most suited for yourself? So do you want to define the rules of the game, or do you want to join? And as a result of these different dimensions, we see 4 different archetypes for financial institutions to position. One is to be a regulatory follower, so doing the minimum necessary for regulatory compliance. Don't invest too much in being a data user, by definition, and really make value out of the data you can get to know about your clients or new clients from other data holders. The second one is being a data optimizer. So really leverage the data to increase, for example, efficiency, and to also increase a little bit the products you have today and the pricing, for example, of your products. The third model is being a data monetizer. So to really use the data you can pull also about your clients and new clients to build new products, to improve your products, and to really make the best use of it. And the last model is a little bit more being a driver of FIDA in the ecosystem. So really try to build and to influence the FIDA in your region, in your market, in your product category, to really define the rules of the game. All of those different archetypes have different implications on the effort and the cost involved, but also on the transformational impact on your organization and the revenue potential your organization can get out of it. Keeping in mind that, as what I said before, that we estimate that 80 to 90% of the investment cost will anyway be on the compliance readiness. So therefore, the additional investment on being more active in the market around open finance is, from our view, probably limited. It's not that much on capex intensive than, for example, the compliance readiness. Now we talked about the shiny and promising FIDA world and the open finance, but obviously no one knows how the market will really develop. And there are also some significant hurdles we see of a FIDA success in the market. And this is also the lessons learned we have out of PSD2 and other regulations. The first one is definitely PSD2 has taken several years to gain significant traction in the market. And therefore, the same can also happen to FIDA. So that FIDA is not directly taking off in the market, but it will take some time till the market gets more mature and also more harmonized on FIDA. So maybe we start with a very fragmented market on the scheme landscape, but after some years, it will go more consolidated, for example. We also don't know how the customer will really react. Is the customer really ready to provide consent to share his data with third parties? I mean, we are talking about financial data where we know that many customers are a little bit more cautious about sharing those. But on the other hand, we have seen if there are clear use cases and a clear value add for the customer, they are willing to do it in many cases. So therefore, it's still a question mark, but we believe that there will be a better customer adoption than pure on the PSD2 use cases. The scheme setup is also a hurdle, how fast this will happen, and also if the regulator will really enforce it after the 18 months, or if there will be more also some extension of the deadlines. And if there is an enforcement of the 18 months and the regulator needs to intervene with a European scheme, how long this will take, for example. And the last hurdle, as also mentioned, is the scheme fragmentation, which will be a lot of operational complexity and therefore also cost for financial institutions, and might also distract the financial institution from really going forward the opportunities and forcing them to focus much more on the compliance readiness by implementing all those different schemes. So maybe to close also the presentation from my side, what should financial institutions do? And we currently see actually 3 different, I would say, phases we see financial institutions in. There is an internal awareness phase where we see majority of the financial institutions currently working on. So to understand better FIDA, to assess the business impact on a high level, to involve the different group entities, because there are sometimes insurance company, asset managers involved as well in larger groups, and to really structure the implications across the different elements of the group. and also have some first ideas regarding the strategic direction and also the need for them to involve in different schemes and scheme creation. The second phase is a pre-study on FIDA's implications, so to really assess what are the implications on FIDA on the business, which on the revenues at risk, what are relevant use cases for them, but also to assess what does it mean for our IT landscape and for our organization, and what would be the budget implications for the next years, and then to really set up a FIDA implementation plan. And few, but there are already some first financial institutions which are actually already working on a FIDA program and really implementing FIDA and really preparing the organization for it. Also see how they can actually make use and benefit of the opportunities, how they can also think about new product development in a FIDA world, and therefore being some of the first ones in the market to really make use of the FIDA. And at the end, there are two also main directions or streams, I would say. One is to look at the financial institution and the impact on the financial institution itself. And the second stream, what we also see is like define how to engage in the scheme development, and discuss with the association, with also other banks in the market or other financial institutions in the market, or even like in Europe, to leverage existing initiatives to build FIDA schemes, or also engage in the complete development of new FIDA schemes. Now I would like to close my presentation, and yeah, I'm open up for, I'm ready to take your questions on FIDA. I hope you enjoyed the presentations, and very much looking forward to the discussion now.
Yes, thank you, Sebastian. Thank you, Sebastian. Yeah, we for sure we did enjoy the presentation. It was very comprehensive, a very good overview, and a lot of details that obviously have kicked up the discussion here in our group. So I will jump right into the questions that came in. And the first one that came in very early is obviously from someone who is very deep in the matter already. So I think it has to do with the points you have touched on, which is confidentiality and the creditworthiness. So the question is, the Commission's proposal, recital 9, excludes consumer data collected as part of creditworthiness assessments from the scope of FIDA. However, all data mentioned in Article 2, particularly data on loans and the repayment, has potential value for creditworthiness assessments as it reflects a person's financial situations. How should these provisions be read together? Does the exclusion imply that data holders cannot share data that data users would use to assess consumers' financial credibility?
No. Exactly, that's a little bit the discussion, or what I mentioned, which is still in discussion between the Council and the financial institutions. Yeah, there is no need, and that's, I think, quite clearly stated, to share the final credit scoring, of a client, because that's protected currently for financial institutions. However, as mentioned by the person who raised the question, there is not a really consistency in this, because as the data points which are currently in the scope also allow and are significant impacts or influence on the creditworthiness assessment for banks, and therefore are not excluded currently. And that's exactly the discussion. I personally doubt that the Council and the regulator will exclude the data points around, like, for example, balances, and obviously the data points about salaries and guarantees, etc., from the regulation. But we will see what happens at the end, the final version.
Okay, so in general, because especially in Europe and in Germany, we do have this data privacy discussion again and again. And I wonder, how was this handled when the FIDA regulation was developed? Was this like weakened or strengthened or supported? What was data privacy's role here?
No, the data privacy is still intact, right? Because at the end, all the data which which should be shared, can only be shared with the consent of the consumer, of the customer. So he needs to give his consent to sharing this data. So without this consent, no data will go out. So therefore, there's still the data privacy ensured. But the question is, or the idea of the regulator is to give obviously control of his data to the customer, and he can decide if he wants to share it.
Okay, thank you. So the next question is, FIDA seems to present considerable cost challenges for smaller banks, such as community banks. These financial pressure could ultimately drive market consolidation as smaller institutions struggle to absorb the additional costs. What is your opinion on this?
Yes, I completely agree. There is definitely an investment burden for many banks. And in particular for the small and mid-sized banks, it's definitely a big burden. And it's not the only one, right? I mean, we have a lot of larger regulations in the European market coming. I mean, we mentioned EIDAS at the beginning. In the European market, also the digital euro will be a significant regulation which has investment efforts. And that's definitely a significant challenge for the smaller and mid-sized banks. And it forces the smaller and mid-sized banks probably also to rethink a little bit their core banking and IT strategies, really going more towards like new providers, maybe, and buying those services more as a service, so that they really get the benefit of opening or of modern platforms which are actually ready already for a lot of those elements of FIDA. But nevertheless, there's a lot of things on the product side they need to do, etc. Yes, there's a burden. If it will lead to consolidation, we will see.
I remember that you have had a chart on the different strategies for positioning a bank, and at the bottom you had the costs. So and the costs for the comply with the framework were always like the same, and the additional cost came by strategy, obviously. Yeah. And I don't want to be too critical on the size of the parts of this, but what is your expectation? And maybe from talking to your customers, are they more on the left side, being more compliant, and this is it, or do they really see the chances here?
I would say majority clearly see the chances. Mm-hmm. They see definitely also the threats which are coming for their own business and revenues at risk. So therefore, probably also the answer is we need to be also offensive about the chances to take. Mm-hmm. But obviously there are some concerns, right? Some concerns about, do we have the resources to do it really properly? Yeah. And I mean, we had the same discussions in many regulation that at the beginning there was a lot of people, of financial institutions seeing chances also in the regulations. Yeah, for example, in PSD2 as well. But at the end, the time pressure, the limited resources pushed then to shift more and more towards focusing first on compliance readiness. Yeah, and then in a second step, look about the opportunities.
Mm-hmm. Okay. Thank you. No webinar without sustainability questions here. So this one, the question is, could you please elaborate on the effect that FIDA could have in collecting ESG data, in particular for SMEs and corporates?
I actually cannot really say. From my understanding, ESG data is out of scope of FIDA, but I'm not 100% sure on this topic, to be honest.
Okay, so we see in the market that there's a lot of ESG data floating around. There's a big discussion on whether this data can be provided by non-profit organizations. I know that Dataland, which is a Frankfurt Main Finance member, is one player in this. So let's see. I personally assume that there might be use of data in certain areas, but sustainability data is obviously still a critical point. What about crypto? I mean, does the FIDA also apply to crypto wallets? Or how are these, like, I just remember Coinbase, are these organizations also part of the scope?
Yes, they're also part of the scope, crypto wallets. And And because I mean, they are considered in this sense of the FIDA regulation as an investment product, and therefore also part of the scope. Yes.
Okay, the next question is again on the credit. Obviously, credit and creditworthiness is a topic. So it's a brief question. Would FIDA, in your view, kill credit bureaus?
I don't think so, to be honest. Yeah. I mean, we have seen the threat for credit bureaus for many years. Yeah, that we said they might be able to be less relevant in the market, but at the end, I think they have a fair point. And yes, there will be more data available. Yes, there will be used more data in the credit assessment per se. But I don't think that they will replace completely credit bureaus. No.
Okay, thank you. So now we have a question concerning the European perspective, and from my point of view, it was really frightening to see that there might be so many schemes on the way, because striving for unity, being in competition with the US market or with Asian markets, and now Europe is again not united here as it looks. So the question that I have here from one of my colleagues is, what will be the likely implication on EU financial market competitiveness by successful FIDA implementation, if any?
I mean, that's a difficult question. Yeah, I think in general, obviously, like the EU is going a big step with the open finance framework. Yeah, we see open finance framework also in other markets. But I think the EU does a big step with this forward here. And this obviously it's challenging to exclude certain players. So therefore, the European market, when opening up, and we had always a discussion, there are maybe some digital ecosystem which are not European, which can therefore increase the competition with banks, and attack banks on as I mentioned, on the client interface more easily than in other markets. Nevertheless, for the overall competitiveness of the market and for also further development of the European banking market, I think open finance is the right step forward. So it will help to build new players. It will help to build new use cases. It will give more value to the customers, being it corporate or private customers. The big question is, who will be benefiting from it? So will it be the European entities jumping on this, or will they leave the field to non-European entities? I think that's the biggest threat it is. And as we mentioned, yes, there is some pressure on margins again for banks. If you need to be more transparent on pricing, etc., it has a consequence, obviously, also on your margins, which might be a disadvantage towards other markets. They're a little bit more protected. That might happen, yes.
Mm-hmm. If I understood you correctly, you mentioned that the banks are more interested in developing their local schemes instead of being late and then getting a European version. Why is this the case? Why is everybody so keen on what are the differences between the European countries, and why is everyone so keen on developing his own version of this?
I would not say that the banks have decided they go for local versus pan-European. They're still, or the financial institutions, they're still very much in trying to explore what's the right strategy in FIDA schemes. I mean, that's obviously the risk if you go on a European level that is much more complex. Much more complex because of different market conditions. Much more complex of more stakeholders involved, which you need to agree on a technical standard, on a governance, on compensation. And we have seen in the past that those large European initiatives would say, bottom-up agreement between many markets can be quite challenging and time-consuming. So I think there is still not a decision. There are some discussions, obviously, on a European level, also leveraging the associations to find the right anchor point there for building the schemes. There are on national levels discussions with the associations and building. And we see some markets which are already started to really setting up schemes and thinking about schemes and designing schemes. This is typically, as we know, more the markets which have maybe a little bit smaller in size, which have a tradition also of a lot of like industry collaboration. For example, the Dutch market is quite advanced on those topics. Yeah, this is benefiting them. But I don't think that the banks have found the right answer to this. But it's time to really find an answer and to really assess the different opportunities they have, because as I mentioned, the time is ticking.
Yeah. As we're doing this webinar together with the Association of Foreign Banks, we have someone asking the question, how can a foreign bank's branch in Germany adapt to FIDA requirements? I mean, not coming from a European company.
Yeah. But I think they can adopt always to the FIDA requirements. So I mean, opening up their own data should not be an issue, in sharing it. The question is about, to be honest, if foreign banks are allowed to have access to the data. That's the main question, right?
And that is not yet answered, is still under discussion. Okay, I see. Maybe one last question from the consumer side, because we have not taken the point of the customer actually. And you mentioned the monetization. So usually, if I allow access to my data, I get compensation in one case or the other. So with FIDA now and the banks being able to monetize the customer's data, will all private accounts be free in the future and will be financed by banks selling the data? Or what is my customer's benefit of this?
I mean, the customer benefit is more on the product side, as I was mentioning. So new use cases which are available on obviously better conditions via price comparison, for example. The banks will make money on the agreed scheme fees or on the agreed compensation model within the scheme, which is like some cents for the data point share. If the new players which are offering the new products, the third-party providers, if they offer products for the consumer for free, if we talk about bank accounts or something, I mean, obviously a credit will not be for free. Then this might be, because he says now that he has a different distribution strategy and therefore can offer products much cheaper or even for free. That the banks will now be reducing their fees. I don't expect this, to be honest.
Okay.
So the consumer value, I think, is mainly in better prices and new products, and new services.
Would have been too nice. One last question here, again with an international scope. So recently, major big US banks have been very defensive about the new open banking regulation, while European banks have reacted less so. What factors contribute to this difference in reactions between the US and Europe, in your opinion?
I mean, I would say when PSD2 was announced, there was not just happiness in the market. Let's say it like this. So there were a lot of financial institutions also saying that they need to share now data without having a cost, sharing data without getting anything. So therefore, I think it was a similar movement like in the US, to be honest, right? Probably they have more accepted with the experience of PSD2 now. What the regulator is going for. The regulator, as I mentioned, has listened to the financial institutions and adopted some things compared to PSD2, that the banks can define the rule of the game. So therefore, I would not say that there's a different reaction. At the beginning, probably everyone and all the financial institutions are not that happy with having to opening up their system. I think that's a probably normal reaction.
Okay, there's there's time for one more question. So it's obviously it's a question of monetization and who is going to benefit. The question is, and for the viewers, sorry, we have to stop after this. So, but thank you very much for the lively discussion here. Do you also see potentially data being used to effectively price discriminate? In other words, not everyone may benefit, but it may boost some firms' profits. So consumers will have to strategically decide to share. Will there be winners and losers in the game?
Yes, yes. I mean, I mentioned before that the consumers are not always willing to share their data. Yeah, sometimes they don't want to have full transparency. Yeah, transparency has always two sides, right? The one transparency is like, wait, so let everyone bid for my product, yeah, and give me the cheapest price. That's one side of transparency, and this has probably the upsides. And then there's a point of transparency. Now someone sees my actual situation and complete situation, maybe even better than my house bank or my bank was doing before. And this can also have an obviously negative impact on pricing. I don't think so much that the margins of certain players will increase, in the sense of they can now price higher just by definition. I think they can price more accurate now, the data. And there is a benefit clearly in skipping some steps of the value chain, right? So as I mentioned before, the distribution. If you take out the distribution, there's obviously more margin for the product provider, and also more to give back to the consumer. So therefore, by disrupting a little bit the current ecosystem and the different value chain steps, I think there are actually more benefits overall.
Thank you very much. Well, we had a lot of questions this time, which obviously shows that this is a very interesting topic, and I think everyone who is interesting and has open issues can reach you at Oliver Wyman and get advice.
Yes.
Thank you, so Sebastian, for your wonderful speech, and also thank you everybody, dear audience, for all the questions. And yeah, our next Food for Thought will be in early 2025, and we will, as always, keep you posted. And as we wrap up our final Food for Thought session of 2024, I want to take a moment to express my sincere gratitude. Thank you all for your active participation, for your thoughtful questions, and for your enthusiasm throughout this year and also of today. Your engagement has made this series a success, and it has been a pleasure showing knowledge and insights with such a dedicated to community. So thank you once again, and thank you again, Sebastian, for the wonderful start in this day today.
Thank you for having me.
I hope we'll see you soon, and stay tuned. Thank you, and bye bye for today.
All right, thank you.